Bismillahirrahmanirrahim. In the previous class, we discussed about the accounting cycle and we discussed about the first four steps in the accounting cycle. Today, we are going to start the next step, that is adjusting entries. Now you know about unadjusted trial balance. It is not adjusted. It is simply called the trial balance. Sorry. Now, adjusting entries. Adjusting entries are prepared as an application of the accrual basis accounting. Because of the accrual basis accounting, we are passing adjusting entries. If it is cash basis of accounting, there is no need of adjusting entries. At the end of accounting period, some expenses may have been incurred but not yet recorded in the journals. Some income may have been earned but not entered in the books. Adjusting entries are prepared to have the accounts updated before they are summarized into financial statements. Now keep in mind, this is 2019. There are some expenses of 2019 like salary. Suppose salary of $10,000 which relate to 2019, but mostly we are paying salary on 6th of every month. So this 2019, it is ending in December 31st. But we will pay salary on January 6th. So now in this case, this is an expense which relates to 2019, but we are paying it in 2020. So for this purpose, for this expense, we will pass an adjusting entry, so it will come in 2019. Keep in mind, there is a principle which is called matching concept. According to this concept, revenues of 2019, it will be recorded in 2019, and expenses of 2019, it will be recorded in 2019. But since this salary expense, this is an expense of 2019, but we are paying it in 2020. So will it come in 2020? No, it will come in 2019. So we will pass an adjusting entry. What will be that entry? Salary expense 10,000 and salary payable 10,000. Now when we will pass this adjusting entry, so this expense will be recorded in 2019. See, we took salary as an expense. So now this expense belongs to 2019. Salary payable, so it is a liability in 2019. When we paid this liability, then we will pass an adjusting entry. We pass this entry on December 31st. And on January 6th, then we will pass a reversing entry because we paid the salary. So salary payable, will debit it by 10,000 and salary expense will credit it by Same is the case of revenue. Some revenues belongs to 2019, but we didn't receive it. So we will record it in 2019. So here he is talking about this thing, that at the end of the accounting period, some expenses may have been incurred but not yet recorded in the journals. Just like the salary. This expense is incurred, but we didn't record it. Some income may have been earned but not entered in the books. There is income earned in this year, but we didn't record it. Adjusting entries are prepared to have the accounts updated before they are summarized into financial statements. Adjusting entries are made for accrual of income, accrual of expenses, deferrals, income method or liability method payments, deferred, those payments that we delayed, prepayments, some payments which are made in advance, etc. So this is adjusting entries. When adjusting entries are passed, the next step is adjusted trial balance. An adjusted trial balance may be prepared after adjusting entries are made and before the financial statements are prepared. Now, after the adjusting entries, we'll make adjusted trial balance. This is to test if the debits are equal to credits after adjusting entries are made. Now, why we are making adjusted trial balance? Because after adjustments, we want to check whether the trial balance, in the trial balance, debits are equal to credits. You people already studied these things, just I'm giving a review of this thing. So that's why I'm not going in detail. If you got some problems, so then you can discuss. You can ask questions. So we are making adjusted trial balance because we want to test whether debits are equal to credits or not. After adjusted trial balance, from the adjusted trial balance, now we will make financial statements. Keep in mind, from this trial balance, unadjusted trial balance, we are not making financial statements. We are making financial statements from adjusted trial balance. When the accounts are already up to date and equality between debits and credits have been tested, the financial statements can now be prepared. The financial statements are the end products of the accounting system. Now, after that, we will make the financial statements. Financial statements, the first statement is income statement, then changes of statement of changes in equity, statement of financial position, that is balance sheet, and statement of cash flow statement, and notes to financial statements, disclosure. This is called disclosure. Below the balance sheet and income statement, there are notes given. If there are some important events in the financial statements, so these important events are disclosed in notes, in detailed notes below the financial statements. We call it disclosure. After the financial statements are prepared, the next step is closing entries. Now, what are closing entries? Closing entries are basically, keep in mind, revenues and expenses. Of 2019, you can't transfer it to 2020. In 2020, revenue, expenses, it will take start from 0. So this year's revenue accounts, all it will be closed. This year's expenses account of 2019, it will be closed. Closed mean we will finish it. So their balance will become 0. Why we are doing this thing? If revenues of 2019, it is 1 lakh. Expenses are 60,000. So the balance, it will be 40,000. That is the profit. Now we got information about profit. But if you will transfer this 1 lakh to here and 60 to here, and we will also include the revenues of 2020. Suppose there is another revenue of 1,50,000 in 2020, and expenses are 70,000 in this year. So the picture of these 2 years, it will be mixed. And we don't want to mix these. So what are we doing? Revenues, we are closing accounts. So next year revenue, it will take start from 0, and expenses of next year, that is 2020, it will start from 0. And there is a principle, matching concept. Revenues of one accounting period will be matched with the expenses of the same accounting period. You can't mix the revenues of 2019 with 2020. You can't mix the expenses of 2019 with 2020. Each year's revenues and expenses will be matched with each other. 2019 revenues and expenses will be matched with each other. So you will get a profit of 40,000. Here 150 and 70, so you will get a profit of 80,000. So there will be a complete picture of each year. This year profit is 40,000, this year profit is 80,000. If you will mix them, then you will not get the exact picture. That's why there is need of closing entry. Temporary or nominal accounts, that is income statement accounts, revenue and expenses, are closed to prepare the system for the next accounting period. Temporary accounts include income, expenses, and withdrawal accounts. These items are measured periodically. We'll measure these accounts periodically. Revenues, expenses, and one account, another account, it is withdrawals, drawings. The accounts are closed to a summary account that is called income summary. We studied this thing in the second semester, and then closed further to prepare capital account, and then this income summary will be closed in the capital account. Revenue accounts will be closed in income summary, expenses accounts will be closed in income summary, and this income summary will be closed into the capital account. Take note that closing entries are made only for temporary accounts. Real accounts are permanent accounts, balance sheet accounts are not closed. Keep in mind only revenues and expenses accounts will be closed, and assets and liabilities accounts, which are permanent accounts, these are not closed. Only temporary accounts. And temporary accounts are basically the accounts of revenues and expenses. Permanent accounts are liabilities, assets, and capital accounts. These accounts will not be closed. After closing entries, will make post closing trial balance. Now, what is post closing trial balance? After closing the temporary accounts, only permanent accounts will be left. Temporary accounts, their balance will become zero. When their accounts, when their balance becomes zero, only permanent accounts will be left. Assets, liabilities, and capital accounts will be left. And these accounts will be transferred to the next accounting period, that is 2020. It is prepared to test the equality of debits and credits after closing entries are made. Why we are preparing post-closing trial balance? Because we want to check their accuracy, whether they are correct or not, whether their debit balance and credit balance are same or not. Keep in mind, in trial balance, if debit and credit are not same, then there will be some mistakes. So that's why we are making this post-closing trial balance. Since temporary accounts are already closed at this point, the post-closing trial balance contains real accounts only. I told you that temporary accounts are closed, so only real accounts or permanent accounts will be left. The last step is basically the reversing entries. Reversing entries are made on the first day of an accounting period in order to remove certain adjusting entries made in the previous accounting period. The adjusting entries which are made in 2019, on the first day of 2020 we will pass reversing entries, but I told you this step is optional step. I will tell you about I will give you an example so this thing will be much more clear to you. Reversing entries for accrued income. Here is an example of accrued income. I told you reversing entries are made for adjusting entries. ABC company is to receive $3,000 interest income at the end of February 2015. They will receive interest income of $3,000 and they will receive this in February 2015. It covers 3 months starting from December 1, 2014, and it will cover 3 months. There are this is basically this $3,000, it is 3 months interest. At the end of 2014, the accountant properly makes an adjusting entry for the month's worth of accrued income. Make yourself clear about the question. On December 1, 2014, suppose we deposit some money in a bank account. On that money, suppose we deposit that money in fixed deposit. And on that fixed deposit, the time period of that fixed deposit, it is 3 months. Now, after 3 months, what will happen? We will receive $3,000 interest. So now these 3 months will cover 2 years. Why? We deposit this money in 2014 December. So 1 month is coming in 2014 and 2 months 2 months in 2015. So now here in 2014 we will pass an adjusting entry. See now, total is $3,000. 2 months belongs to 2015 and 1 month belongs to 2014. So mean monthly interest is $1,000. So mean $1,000, it is the revenue of 2014, and $2,000, it is the revenue of 2015. Now what is he saying? Now we will pass an adjusting entry in 2014. Interest receivable, because this money is not received, so it will be interest receivable, account receivable type of thing. Interest receivable in 2014, I am passing this entry on December 31, 2014. So interest receivable will be debited by $1,000 and interest income $1,000. For this $1,000, we didn't receive this money. Keep in mind, we will receive this money at the end of February 2015. But since this is income of 2014, so we will pass an adjusting entry. So interest receivable, this interest will be received in 2015. But when 1 month is over, so we earned $1,000. So we will write it in our income, and it will be interest income. Now see, this is the month of December, this is the month of January, and this is the month of February. We deposit money here. 1 month is passed. When 1 month is passed, we earned $1,000. $1,000 here and $1,000 here. So we will receive total $3,000 here. Now see, this $1,000 we earned because the month of December, it is over. So we earned this money here, $1,000. So for this $1,000, we will pass an adjusting entry. Since this money is not received, so it will be interest receivable, just like account receivable. 1,000, and since we earned this money, so it will be interest income $1,000. So see, interest receivable and interest income. At the beginning of 2015, the accountant can prepare this reversing entry. Just reversing entry is what? Just reverse this entry. Interest income, we will debit it, and interest receivable, we will credit it. The adjusting entry is simply reversed. Debit what was credited and credit what was debited. Inshallah, in the next class, we will go in detail of this reversing entry. A lot of other things in this, so inshallah we will discuss it in detail. Have a good time. Assalamu alaikum.